All right, if you're a Canadian farmer, you know this better than anyone. Timing is everything. But what do you do when the absolute best time to buy that new piece of equipment is the absolute worst time for your bank account? Well, in this explainer, we're going to break down exactly how to get the financing you need, but on a schedule that actually works for your farm, not against it. And this really gets right to the heart of the problem, doesn't it? I mean, you've got these massive expenses in the spring to get everything in the ground, but the money from all that hard work, yeah, that might not show up for months, maybe not till fall. It's the classic and, frankly, super stressful cash flow crunch. Just take a look at this. It really paints a picture. On the left, you've got your typical business, steady, predictable income month after month. And that's what almost every standard loan out there is built for. But then you look at the right, and that's a farm. You see these huge revenue spikes after harvest, followed by these long, long valleys where not much cash is coming in. It becomes crystal clear really fast why a standard monthly payment is just a terrible fit. Okay, so let's dig into that a little more. What is it about this mismatch, this one-size-fits-all loan, that can cause so much stress for a farm? Yeah, this quote just hits the nail on the head, doesn't it? When you're stuck making these big monthly payments during your lean months, you're doing one of two things. You're either draining your cash reserves, which you desperately need, or you're just living under this cloud of constant stress. It's just relentless. But, and this is the important part, there is good news. Solutions are out there. It's kind of like a secret menu for farm financing that a lot of your regular lenders just don't offer, or maybe don't even know about. So, let's pull back the curtain and look at the options that are actually designed for how a farm really works. Okay, first up is probably the most straightforward one, annual payments. Pretty simple, right? One large payment per year, timed perfectly for when your cash flow is at its peak, right after harvest and sales. It makes things really simple. The only thing to keep in mind, of course, is that it is one big payment, so you have to be ready for it. Then you've got semi-annual payments. This one kind of splits the difference. It's perfect for farms that have a couple of distinct revenue bumps during the year. Maybe you have some sales in the spring and then a big harvest in the fall. This structure lines up with both of them. Now this can be a total game changer. It's called skip payments. The idea is you still make monthly payments, but only during the months when the cash is actually flowing in. So for all those lean months before harvest, zero payments, nothing due. Think about how much cash flow that frees up right when you need it most. And here's another really powerful one, the deferred first payment. Just imagine this. You get that brand new piece of equipment delivered in the spring. You use it the entire season, it helps you make your money, and you don't make a single payment on it until the fall when the cash from that harvest is actually sitting in your account. Pretty great, right? So here's a handy little summary. It lets you see all these options side by side. You can quickly figure out which structure might be the best fit for your specific operation. And you can also see the key trade-off for each one. Super useful. Okay, so now that we know about these different payment structures, the next big question is, where do you get them? Who do you talk to? Because picking the right lender, someone who actually gets farming, who speaks your language, that's every bit as important as picking the right payment plan. You've basically got three main choices. First, you have the specialists, like Farm Credit Canada, we'll call them FCC, who do nothing but agriculture. Then you have your traditional big banks. And finally, there are private or alternative lenders who can sometimes be a good fit for more unique situations. And this quote right here, this explains perfectly why finding a specialist is so important. A regular banker might look at your bank account in February, see the balance is low, and start to panic. But a farm-focused lender, they see the whole picture. They don't sweat the February balance because they know the revenue is coming in the fall. Honestly, for a lot of farmers, FCC is the place to start. Their entire system is built from the ground up for Canadian agriculture. You're not going to have to waste time explaining the basics of farm cash flow. They just get it. And on top of that, they've got all these great programs, like for young farmers under 40, or for something as complex as succession planning. Now, this is something you really need to know about. It's called the Canadian Agricultural Loans Act, or CALA. Basically, it's a government program that guarantees these loans. So if you're talking to a traditional bank, you have to ask them, is this loan eligible for the CALA program? Why? Because with the government backing it, the bank takes on less risk, and that can translate directly into better rates and more flexible terms for you. It's a huge deal. All right, let's switch gears for a second and talk about a big strategic question. To lease or to buy? This isn't just a simple choice. It can have a massive impact on your taxes. This is definitely a conversation you want to have with your accountant.
So, the biggest difference between the two really boils down to your taxes. When you buy something, you own it, right? So, you have to depreciate its value over time, and you claim a piece of that each year. It's called the Capital Cost Allowance, or CCA. But with a lease, well, in many cases, you can write off the entire lease payment as a business expense in the same year. That's a big difference.
Let me give you a really concrete example. A hopper bin. If you buy a hopper bin, the tax rules, the CRA rules, say it can take over 20 years to fully write that asset off against your income. 20 years! But get this, if you lease that exact same hopper bin, you can potentially write off the whole cost in as little as 3 years, just through your lease payments. That is a huge tax advantage. It can free up a ton of cash. Okay, so we've covered a lot. The big question is, how do you take all this and put it into practice? Let's go through a quick checklist for building the strongest possible application to get the financing you actually need. Being prepared and getting ahead of the game is everything here. So step 1, apply early. Don't wait until you're desperate in the spring. Start the process in the winter. Step 2, bring your complete financial picture. Don't hold anything back. And maybe most important of all, step 4, go in there knowing what you want. Don't just ask, what can you give me? Tell them, I'm looking for a skip payment plan. It shows you know your stuff. And finally, let's just quickly touch on a few common pitfalls to avoid. First, don't get mesmerized by a low monthly payment. You have to look at the total cost of borrowing. Second, always get a second quote. The financing the dealer offers isn't always the best deal out there. And of course, don't forget about those huge tax implications we just talked about when deciding between leasing and buying. So, at the end of the day, it really comes down to one simple question. Think about it. Your financing is a tool, just like any other piece of equipment on your farm. And with the right knowledge and the right partner, you can make sure that tool is working just as hard as you are to help your farm succeed and grow for the long haul.